let's look at Amazon. What is Amazon doing today? It's one of the most influential companies in the tech world. You see its shipping truck, you see its shipping vehicle everywhere on the highway, almost becoming a shipping company, right? Well, it started as an online bookstore back in 1994 and transitioned to a giant tech company doing e-commerce, online shopping, cloud computing, logistics, and AI. Its biggest revenue is from Amazon Web Service. It's what's driving Amazon's growth over the years. But the question now is whether Amazon will survive competing with all the competitors and stay profitable with all the tariffs, oil rising, and adapting to the new chip driving world. We'll look at its 3 months outlook and determine where to buy and sell. Well, first let's look at its fundamentals, because if its fundamentals is not a buy, we don't even need to look at the technicals. For the fundamentals, forward PE is at 27.93, so almost 28. Forward PE is like the regular PE ratio, but forward looking. It's looking at the futures based on the future earnings. Around 28, it's not cheap, but it's not expensive. It's around the okay area. Free cash flow is negative 2.47 billion, almost negative 2.5 billion. That's a little bit of concern. It doesn't have free cash flow to maneuver around, to invest, to do research. It's a little bit surprising too. Revenue growth is how much a company's sales have increased over time. We want the company to keep growing. It's at 14, so it's relatively good. It shows signs that the company is growing. PEG ratio, price earnings to growth ratio. It is like the regular PE ratio, but add a growth factor to the formula. It shows whether a stock is cheap or expensive relative to how fast it's growing. When PEG ratio is around 1, it's fair value, meaning PE matches the growth rate. Less than 1, it is undervalued, which is a discount price for investors like us. Greater than 1 could be overvalued, meaning we're paying extra for the growth. Amazon is at 1.3, so it's a little bit overvalued. ROE, return on equity. It is how efficient the company is making money for every dollar that shareholders have invested. So we want the company to be very efficient at generating money for us. It is at 24.28. That is a strong number. Below 10 is a weak reading. Around 10 is okay. 15 is good. Above 20 is very strong. Did you notice something interesting? Why is the free cash flow is negative? They don't have free cash, but ROE is relatively positive. It's a really good number. How are they generating money for us while the company doesn't have free cash flow? Well, these two indicators are pointing different things. The free cash flow is the cash that's left over for the company to pay other stuff, buy new stuff, invest in other areas. And ROE is how the company is generating money. So it is true that a company can have low or negative free cash because it's spending a lot on the new shiny stuff, but generating a lot of money because it's still doing good, it's still profiting. If you can imagine a lemonade stand, it's making good money every month, the cash jar is piling up, but it's spending a lot of money buying new juicer, more cups, better lemons. So the business can have low cash, low negative cash flow, but it's generating money. The cash jar looks good. So which one do you trust? Well, you look at them all as a whole, not a separate indicator. So now we have a picture. Amazon has a few red flags, but overall, it's a buy. Well, then where is the buy point? When we look at the chart, it's pretty wavy, right? You can see it was up 200 SMA and then down and then above, making new all-time high, and then going down below again, and now it's trying to go up. So technically, a good buy entry point would be around just here, just recently now, around 240, because we are well above the 200 SMA, a big buy volume. We are able to stand firm above the 200 SMA. So this is a good entry point. And I would take profit about 280, around all-time high. And then cut loose would be below 220 or 225 if you want to be more conservative. We don't want to panic sell when it just swim below 200 SMA. We want to watch and observe what it is doing around this area, because there's two conditions. When it swim under, it will try to go above again. It will try to swim above again, or there shows no signs of life. It just keeps sinking. So if it's the second case, we do want to cut loose and move on to a different stock, because we don't know how long it will swing down there, while other growth stock is moving faster. When to add or where to add. If you miss the first entry point, you could add around 245 to 255. This area is a good add point too, so there's always another chance. Have your plan, have your strategy, and think in midterm. The reason I say 3 months is because we don't know what's going to happen in the near future. A lot of the giant company, they were giant and they would disappear slowly and quietly. So take profit while you can and cut loose when you have to. We can't sell at the top, but we can take profit while we can and move on. Lastly, important dates for Amazon. Earnings, July 30th. Expected move is 9.1%. So is it going to be another chance for it to push all-time high and beyond? Or is it going to drop and stay down here for another while too? It could go either way. All right, thank you for watching. I'll see you again.